The Roundhill Weekly Pay ETFs are starting to make some serious noise in the high-yield income space. They're pumping out some of the highest annual yields we've seen lately, the kind that's making income investors do a double take. And the latest weekly payouts, especially for the week of August 15th, 2025, let's just say they're eye-popping. For a weekly paying income ETF, these numbers are almost unheard of. Just look at some of these numbers. Roundhill's Robinhood ETF, ticker HOOW, is pumping out a distribution rate of 182.66%. Their MicroStrategy ETF, MSTW, sits at 170.34%. Palantir's PLTW, 152.44%. Tesla's TSLW is paying 132.45%. And Nvidia's NVDW comes in at 107.95%. And that's not even the full list. It just keeps going and going and going. These are jaw-dropping payout rates for any ETF, let alone ones paying weekly. The reason these numbers can't just be brushed aside is that, in many cases, these ETFs aren't just pumping out massive yields, they're also holding up surprisingly well when you look at total return. And that's where things get interesting. Usually, when you see ultra-high yields like this, you expect the price to be getting crushed, wiping out most of your gains. But with some of these Roundhill Weekly Pay ETFs, that's not what's happening. In fact, in certain situations, take HOOW for example, they're not just matching their underlying stock's performance, they're actually outperforming it. Yep, the Robinhood ETF is edging out Robinhood stock itself, even after paying out those huge distributions. That's pretty wild when you think about it, because it means investors are getting both the high income and competitive total returns, something you almost never see with leveraged or high yield strategies. These funds have actually impressed me so much that I've taken a small position in a couple of them because they check off a few boxes I've been looking for in a high yield income fund. First off, they pay seriously high yields. Second, their performance so far has closely matched their underlying stocks, and in many cases, they've actually outperformed them. That's rare for high yield strategies, and it's a big reason I'm paying attention. Third, their strategy doesn't cap the upside, so if you're bullish on a stock that happens to be part of their weekly lineup, these ETFs might give you a way to ride that bullish wave while collecting much larger returns and weekly income at the same time. And lastly, the leverage is modest, just 1.2x. It's enough to boost returns without going overboard into risky territory. But, as much as I like them, there are still some key things to be cautious about. Number 1. High volatility and risk. These ETFs use derivatives and that 1.2x leverage, which can amplify losses if the underlying stock takes a hit. Number 2. Single stock concentration. Each ETF is tied to just one stock, for example, NVDW tracking Nvidia stock. That means there's zero diversification inside the ETF itself. If that stock tanks, the ETF tanks right along with it. Personally, I deal with this by balancing my positions carefully, kind of like building my own mini ETF across multiple holdings. And number 3, they require active management. This isn't a buy and forget type of investment. The high volatility and leveraged structure mean you have to keep an eye on them and be ready to adjust if the market turns against you. So yes, they've got qualities I really like, but they also demand respect, discipline, and a plan. At the end of the day, these types of investments really come down to what fits your personal goals and risk tolerance. The exact same fund might look like a golden opportunity to one investor and a complete pass to another. I'm also keeping in mind that these ETFs are still fairly new. We've seen it happen before with other funds. They launch with sky-high payouts to attract attention, and over time, those payments start to shrink as more inflows come in. I'm really hoping that's not what happens here because that would be pretty disappointing. Hopefully, the folks at Roundhill are listening and keep these performing well for the long haul. Bottom line, the Roundhill Weekly Pay ETFs are definitely worth at least a quick look to see if they align with your portfolio and your strategy. They may not be for everyone, but for the right investor, they could have a place. As always, this is not financial advice. This video is for entertainment purposes only. Always do your own research and speak with a licensed financial expert before making any investing decisions. And if you got value from this video, don't forget to like, subscribe, and hit the notification bell so you don't miss any of our future content. Thanks for watching, and I'll see you in the next one.